Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for the week ending Friday, April 26, 2019. I've cut back on the public updates, the public videos, because those are just general stock market analysis. And again, nothing has happened now in weeks since anything significant, any technical developments worth noting. Again, 60-minute charts really don't matter too much right now unless you see something very compelling there. So I've cut back the updates. I've done 7 videos this week, but only one on the broad markets, one public content video. The rest are other things we're watching. There's a lot actually right now, and I'm a little excited about that. I'm finally seeing some disparity, some movements in the sectors. Maybe I'll touch on that. From the beginning of the year when the rally started, everything was moving in tandem. It was what I call a reinflation trade. Money coming back into the markets and in the sectors and everything that got beat down. But about the midway point, we started to see some divergence, and lately we've seen even more of that. So it's a good thing for swing traders. Swing traders, they make money when there's volatility in the market and price movement in both the broad market or opportunities in sectors. Market can be going one way or the other, and that doesn't matter if you have a bullish or a bearish sector or a commodity or something we're trading. And again, we haven't seen a lot of that for quite a while now, but we're starting to here. So let's just do a quick review on the broad markets, and I'll touch on oil. Typically that's something covered as premium content on the site, but because it does relate to the broad market, I'm going to touch on that real quick because we definitely had some movement there today and a potentially technically significant event. Excuse me. All right, so here's SPY daily chart. Here's a trend line off the lows. So I'm going to run through the major indexes real quick to start out. Just a quick recap, and I know members, you've seen this probably 3-4 times this week in the updates. We've had a breakdown here of the SPY, very unimpulsive, exactly not what you want to see for a breakdown. Just a small move and close below that hit 288.83 as minor support right here. It was resistance. SPY broke above it and then back tested, and you can see we held that for a few days. Back tested the primary trend line from below, kept the divergences still very much intact right there on the RSI and the PPO, and have just moved sideways since. And as I said before, it even happened, you have to see tech break. QQQ and XLK need to break. I'll get to those two in a second, and they haven't broken yet. But we do have, and it's worth noting because this is more representative of the overall stock market, we have this breakdown in SPY. We also have it in the Dow. Here's DIA, the Dow 30 tracking ETF. There's your trend line off the lows. We broke down yesterday, and we remain below the trend line today. So there's one as well. MDY, or the mid caps. Let's not forget the mid and the small caps. Hugging the line. We've had 2 intraday breaks, but as I often say, if you're trading the daily time frame, all that matters is how you close the day. And so far, it looks like this just another intraday break, just like yesterday. You can see that candlestick tail. The skinny part there, the shadow, that just means we broke intraday, but then we closed right back on the trend line, and again we're back above it today. And the reason I'm doing this video before the market closes, I don't care if the market turns around and dumps. It's not going to dump 300 points into the close, not today. So we're going to close on or a hair below, if worst case scenario, these trend lines. So for all intents and purposes, we're not going to break support, and it's more the same to be continued next week. But again, let's point out these levels ahead of time, because I'll tell you this: by the time we finally do have a breakdown, if it comes, it can come in a big red candle, and that's what you're probably going to be looking at here with all the excesses we have right now, in these extreme overbought conditions, the divergences, everything else. My guess is when it finally gives way for good, you're going to end the day well below those trend lines with a big red candle that's probably going to wipe out possibly the last couple months of trading here, at least a couple weeks there. So we'll see what happens. But there's the mid caps, still well off their highs from 2018, and then let's not forget about the small caps. Small caps have been lagging in relative terms. They've actually moved up about the same amount as the S&P 500. I think I measured it out before. I think they're both up about 25%. But what's unusual, it's been a complete risk-on rally, but yet this is the king of risk-on indexes, the small caps. And as I mentioned in a video earlier this week for members of the site, that's the small cap index is much more representative of the U.S. the U.S. economy than is the S&P 500. The S&P 500, those companies are multinational companies. They derive a good percentage of their profits from overseas sales, where you have most of the companies in the Russell 2000 small cap index are domestic-based companies, much more sensitive to the economic going-ons in the U.S., whether economy's chugging along or not. And you can see here, I have Fibonacci's. No, I don't. I thought I had them up here somewhere. Here, let me just get let me find a board here and throw up some Fibonacci levels. So as you can see, IWM from the move to the highs to the lows, we've come up and we've retraced a little bit better than 61.8% retracement, but you can see we're still well off the highs. But as far as price goes, let's watch this. Let's go back to that board we have here. Look at this line. Let me just remove the fibs. The small caps do appear poised to break out, and they could run. Now you have cross currents. You have the divergences, just as you do, or you have, I should say, potential divergences. To complete those divergences, we'd have to take out. We have a previous reaction high here. You have to match or exceed that high, as this line would show, and then you would have negative divergence there as well. So, I mean, that's the common theme here. We have strong divergences across all these indexes. As I always say, divergences in themselves are not buy signals, not even close. They're just merely an indication that an impending trend change is likely. These divergences need to be confirmed with this PPO and the RSI turning back down, and most importantly, you need a sell signal, and that can come in various forms, including a break on the trend line off the lows. Let me see. I don't even know if we have a clean trend off on IWM. It's not as clear. IWM's kind of been doing its own thing. Again, the small caps peaked back in late February and are still below there. But when I look at this, just on price alone, you do have to be aware we have what takes the form of an inverse head and shoulders pattern right here. You have your left shoulder, right shoulder, and a neckline. And whether or not that qualifies as an IHS pattern, it's hard to argue that that level I just showed you right here, roughly 158.62 or 159, it's certainly an important technical level. Look how many advances have been capped by that level. So if the small caps can punch above there, that's bullish unless it's a failed breakout, meaning respect it for what it is. If you pop above there, keep an eye on everything else. I have to imagine if the large caps broke support, they would probably bring the small caps down with them. They usually do. So bullish if it breaks out, and then bearish if the breakout fails, especially if it fails impulsively. I'll say this too, and this holds true with the broad markets, which I'll get to in a second here with SPY. Breakouts very often are back tested, and when you back test, sometimes you come in a little below the actual level. So it's not the end of the world in other words, if you pop it and come right back down under 158.62, that doesn't mean, oh wow, there's a huge failed breakout. You just have to kind of watch the price action, watch everything else, watch what are the large caps doing, the mid cap, the tech stocks at the time, and then if we do fall back, what does it look like? Do we come back on relatively low volume, move through there, or do you see a big red candle that looks like this and just wipes out weeks of trading? That would be bearish right there. Whereas, orderly pullback might not necessarily be. So I don't mean to be ambiguous or unclear. It's just there's a lot of variables and things that go into this, so we'll have to watch this. But like I said, the small caps, something's going to give here. There's going to be a mean reversion between the large and the small caps soon, I believe, and that can mean one of two things: either small caps play a game of catch up, or the large caps catch up to the downside. And we'll see. Now here's tech. Here's what's driving the market, what has been driving the market up, or what's driving the market up today. Quick evidence of that, as I'm doing the video, the Qs just went flat on the day. Anytime you want to check, kind of get an idea how healthy the advance is, just pull up QQQE, the equal weighted NASDAQ 100 ETF, and you can see that it's down by a quarter point, not telling the same story. In fact, it's already broken down. And why? Amazon, that's why. So that's it. You have the heavy weighting, and Amazon, of course, is up today, big on earnings. As much as Intel is down, Intel, it just goes to show you what that overweighting position in Amazon does. Amazon's up a lot less than Intel's down. Intel's down, last I looked, over 10%. Amazon only up a couple percent, and yet that's, again, that's why it's turning the Qs green. So you back out Amazon, that wouldn't be the case today. So what do we have here? I probably should have given you a clean board. Let's see if I can find one. Yeah, close enough. We'll use this one. Here's that trend line. Here's your move off the lows. I'm sure a lot of people are watching this, and you tighten it up here, come and catch all these reactions, as many as you can. And what do you have? You had an intraday break, but it managed to close right back up above the trend line again. And again, another intraday break. But I'll tell you, this is signs of weakness. Usually, when you see a very long in the tooth rally, a very extended trend line start to crack, and you see prices hug the trend line during a healthy advance, you kiss it and you run, you kiss it and you run. But when the trend starts to become exhausted, and that's what the momentum indicators are there for, they tell you momentum is waning, prices can't come down, and they tend to hug that trend line, like an exhausted man overboard would hug on, grab a life preserver who's out of breath, out of gas. That's what's happening here so far. However, we don't have a sell signal, and that's that. So we're going to watch these. Who knows? Maybe the Qs will get another breath of life and rally on up here. But it looks to me, you can see price compression in the candles, and again, dipping below here a couple times. We've had some stick saves, but no sell signals yet. And as I said, I don't care what SPY and DIA and MDY and IWM do, until tech breaks and QQQ, the market's not going to break. Here's XLK, the largest sector in the S&P 500. This is what's driving up both the S&P 500 and the NASDAQ. You can see we had a close call today. I had a price alert fired off. I was doing a video this morning, earlier today. We broke below there, but you can see another stick save. And again, now a little over 15 minutes ago, it doesn't matter if we dump in the close and close just a hair below. You need to see a solid impulsive close down below. Right now, again, for all intents and purposes, well, we're actually right above the trend line, and again, unless we had a huge dump into the close, it's not going to really make much of a difference. So to be continued next week. Maybe that comes on a gap down that traps everybody in, that's long, leaves the shorts, deny them an exit, or an entry, or maybe we hold support again, just as we did back here and here and here. Lot can happen. So we'll have to watch the nature of the breakdown if and when it comes, and then try to gauge, will that be it, or maybe it'll be a breakdown and then a kickback rally, just like the SPY back tested. I don't know, but I suspect, because this is a crowded trade, I suspect it'll be more of a quick rush for the exit type drop, at least the initial thrust down there, probably 3 or so percent before we even catch a decent bounce. Okay, and for you futures traders, or even those of you that trade the Qs, you might want to keep an eye. I prefer to watch, the charts NQ and all the index futures, or really anything I'm trading. If I'm trading oil, I'll usually trade futures, but in other accounts, like some IRAs and things, I'll trade ETFs as well. However, this is what you want to watch in addition to what QQQ is doing. Obviously, they'll be mostly the same, but sometimes you get some additional cues. You can pick up on some divergences or trend lines or support levels that you don't see in QQQ, because the futures are trading virtually around the clock, and that's it. I mean, it's just a very clean trend line wedging its way on up. Remember, this is only a divergence line on the top. It can grow, it can expand. This could turn into a price channel. The divergences could be negated or taken out, and that meaning we move up above there. But the bottom line is we have to watch this level. We had a little intraday break today, but you can see it's not impulsive. So if you're trying to get a jump on a short trade, you want to see a big red candle down here, ideally a solid 60-minute close below. Otherwise, if you look close enough, I don't know if you can make it out in the video, there's a couple little brief pops below that trend line right there lately. But again, it does show that the Qs broke out, the Nasdaq 100 broke out to all-time highs. So where's the big rally? Where's the big sharp move? The buyers haven't stepped in and followed through on the breakout. It's just been, we've been limping along this trend line, and again threatening it with a couple false breaks there, but nothing yet. We don't have any sell signals yet, and let's just leave it at that. Okay, and finally USO, and again, typically commodities, gold, anything other than the major stock indexes that's premium content on the site, but this is relevant to the stock market very much so, because it's had an extremely tight correlation. When stocks peaked last October, so did oil. They both fell in tandem. The only difference is you get about a 2-for-1 bang for your buck if you go long or short crude. What I mean by that? Well, you can see here oil fell about 43%, nearly double what the stock market fell. And then when it found a bottom on December 24th, same day the stock market bottomed, it rallied up about, you can see 51%. Nearly double the stock market. So you want to trade USO. This correlation may not continue. There are times there's a disconnect, but you're looking at almost a 2-to-1 leverage factor, if you will. Now keep that in mind and adjust your position size, because see, here's an example. Crude's down 3.5% today, so it cuts both ways. Don't always just focus on the gains. You have to say, okay, if I normally trade X amount in SPY or QQQ, I'm going to trade 0.5x or half X in USO, and then what that's going to do when the trade moves against you, it's going to your losses won't be as big, or they'll be comparable in dollar terms. Now, so what I wanted to point out today, big breakdown there in USO, and again, this has been coming for a while. We've been extremely overbought. We ran into some pretty significant resistance. You have to the left of the chart here, you can see the Fibonacci level. This is a 61.8 fib. I have a horizontal price line over it. There's a dotted line under that 1355 level. 1355. There's all these reactions here. Support there. We broke support. It was resistance right here. Support again. And once we broke it, waterfall sell-off. And so you ran into, just recently, overshot it by a hair, that key 61.8% Fibonacci retracement of the entire move down, and the 1355 level. And we got a jump on that yesterday in the trading room. Posted right here that crude was breaking down below this minor trend line at 65.59. Mentioned any or all these as potential swing targets, with that being the first target there at 64.58. Let's see, posted a little 2-minute chart showing that waterfall. This was the trigger intraday, watching this level here. That was right on that trend line on that 60-minute chart I showed you. So you can see, boom, there it was. That's what we call an impulsive breakdown. So this is how you can get a jump start, and you can even zoom down here, to a 1 or 2-minute chart, and get a head start on a trade. So this morning, you can see we hit that 64.78 target almost perfectly, and then bear flag there. This is a bear flag consolidation right on support. There was your flagpole. The bear flag broke down, and where are we now? Let me grab that chart. Oops, hold on. There we go. All right, so this is it. This is the crude chart, and again, that's what you call impulsive selling. If you wonder, I use that term regularly. This is impulsive selling, and that pretty much, you can see we smashed through that first support. We took out this minor trend line as if it wasn't there, and again, that's a minor trend line. We overshot that 63.14 target, came down to about that 62.03 level, but bounced right back to it, and that is resistance, my friends. Support, once broken, becomes resistance. So that puts crude in a precarious position. Now, it's very oversold. Oversold doesn't always stop crude, nor does overbought. So keep that in mind. Here's what it looks like. Guys, I haven't had time to clean this chart up. It's just a daily chart of crude futures. And again, you can see the same trend line off the lows. So why I wanted to include this again with stock market analysis is they've had such a tight correlation. Anything's possible, back test, a false breakdown next week. But as of now, you have to sometimes just take the technicals for what they are. And that is a very impulsive break below a well-defined trend line off the lows. So if the correlation sticks, one of the two has got to happen. Either the stock market will also break its comparable support that it's dancing on right now and probably happen next week, or this proves to be a false breakdown, and then you buy crude. I wouldn't go long here. I'm still short. I said yesterday when I posted that short setup earlier in the day on the breakdown, I said I'm going to swing trade a day trade position down to the first target, cover that there, and then just tuck away the rest as a swing trade, set my stops and let it ride, because this is a major breakdown, and if it sticks, there's not a whole lot to stop crude until you get down here at about that 57.86 level, and that would be a pretty decent drop from where we're at now. Let me try to tell you how much more downside here. Measure that down from here to here. Where we're at right now there. That's about a 8% drop. So just food for thought there, and I severely doubt, if that plays out, again a big if, that we drop 8% in crude, I severely doubt the stock market's going to hold up or continue to rise, again based on the correlation and everything else there. All right, we're going to wrap it up here, and again, to be continued next week. Watch those trend lines on the NASDAQ 100 futures, the Qs and XLK, and just have your ducks in a row. Maybe this market continues to keep defying technicals for another 2-3 months. Sooner or later, usually they do succumb to the technicals, and right now, like I said, nothing's changed for many months. Divergences build, we keep walking up trend lines, except this time around we're very overbought and extended. Therefore, that just sets the stage for an even, instead of just a run-of-the-mill, 3-5% correction, potentially for a lot more, especially a swift drop if you get a one-sided kind of rush for the exits trade. All right, we're going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great weekend.